Good morning. Today I'll be presenting on the impact of COVID-19 on the United States stock market and the Federal Reserve's response. What is COVID-19? COVID-19 is a very infectious disease originating from Wuhan, China. It is currently more deadly than the flu. One of the most difficult aspects to this virus is that it's novel, so there's no built-up immunity in the population. And there's very little known about the virus, which makes it extremely dangerous. It broke out in China in late December when it first started to jump from animals to humans. The first case in the US was shortly after that in late January. It was a man that came from China and from the Wuhan province and traveled to Washington State and brought the virus to the US. In the early stages, the coronavirus started very quickly to steal attention for the western part of the world. It was already taking hold of China and spreading rapidly, but the West started to take notice as the first death in the US was in late February, and it was already spreading rapidly throughout Italy and Spain and starting to spread farther through Europe. It was starting to damage supply chains, and speculation led to drops in the market. People were concerned about how this could affect production and performance for companies, and we started to see drops in the market in late February before we really understood what this would be, and people were starting to become more worried and panic more, and fear began to grow. The Federal Reserve started with a preemptive strike. On March 3rd, the Federal Reserve cut interest rates to 1 percentage point, interest rates by 1 percentage point to a range of 1 to 1.25%. This was before there was massive concern in the population about the coronavirus. It seemed kind of premature for the Federal Reserve to cut the rates this much this early on, but they're anticipating a great economic impact of the virus. This cutting of the interest rate caused markets to plummet as concerns about the virus grew due to the Fed's action. Many people weren't sure what impact this virus would have. It was thought that it might just impact supply chains and slow production a little bit, but when the Federal Reserve felt they needed to cut the interest rates by a full percentage point, that brought a lot of concern about what might really happen to the economic climate with this virus. This cutting of the interest rate was done to encourage spending and investing and to mitigate the economic impact from the virus early on, so that hopefully there wouldn't be too much destruction of the economy. Some people might consider this too early to be doing this because they exhausted one of their measures of stimulating the economy very early on before too many concerns were brought up in the market and in the economy. As you can see in this graph, they dropped the interest rate on March 3rd, and after March 4th, the Dow Jones Industrial Average dropped greatly and dropped for several weeks until it reached its 4-year low below 19,000 points. After the Federal Reserve made this move, fear was starting to grow as more reports about the virus came. More doctors were warning of different concerns and what might happen and the impact of this virus. Economists were starting to warn what might happen. Companies, schools were beginning closing. Virginia Tech had rumors prior to spring break about going online, which they ended up actually doing. All this speculation drove the stock market down. As you can see in the last graph, it was these several weeks where it just kept going down because there's speculation, fear coming out, more news about the virus, and more news about how bad it could be and how quickly it could spread, and more officials warning of the dangers. And considerations of lockdowns and closing businesses and social distancing measures, the models and projections look detrimental to society, the economy, and the market. They're projecting death rates of around 5% or more in some cases, which would destroy the economy and cause a lot of death and carnage to society. And so all these fears help to drive the economy down to where it actually dropped over 10,000 points from its all-time high the Dow Jones did from its all-time high very quickly because of this uncertainty and this fear of what could happen and what this could turn out to be. While hysteria started to ensue, we then saw panic buying as shelves were ravaged for toilet paper and hand sanitizer. There were pictures all over the internet of people buying absurd amounts of toilet paper and purchasing cleaning supplies, and shelves were just completely empty from canned foods and cleaning supplies and wipes and toilet paper and hygiene stuff that people were concerned they wouldn't be able to get. And the more people that kept buying these things, the more we were running out because everyone felt they needed to buy it because it started running out. And then businesses were unable to keep up with demand. And a lot of this is because we have just-in-time supply chains in the United States where company stores get their supplies and their products shipped in just in time to keep up with demand. So if they expect to sell a certain quantity of something each week they get just the right amount they need and just the time they need it. But when you have a pandemic like this, it increases the demand curve and shifts the entire demand curve up very quickly. So supply chains were not able to keep up with the initial demand. We have since seen an increase in supply to keep up with this. And that's helping, but the concern as businesses couldn't keep up with supply and people were worried about being able to buy food, there was less investing. People started to pull money out of stocks, put into safer things like bonds and CDs. And consumers started to prepare for no work, but still needing to buy food. So if you have no work, but you need to buy food, you're going to take money out of investing. You're going to take money out of the stock market. You're not going to be as confident to invest. And you're going to save your money for if you need to buy food in an emergency so that you can survive. So the confidence in the market started to drop as the market kept decreasing. There's less investing because people had other concerns, which this all continues to stifle the economy. The next thing that continued to drive the market into a deep hole was the travel bans. On January 21st, Trump imposed travel restrictions from China, which a lot of people didn't understand at the time why he was doing that, why it was necessary. It didn't seem that the virus was that bad, and we didn't understand much about it. So there are concerns about the travel restrictions from China because that could also impact different supply chains, and we get a lot of our supplies and a lot of our products from China for our United States companies. After the China ban on February 29th, Trump restricted travel from Iran. This wasn't too major for most of our economy, but could have an impact on oil and politics. On March 11th, restrictions for travel from Europe were imposed, which this was massive because we have a huge connection with Europe, and there's a lot of concern when this was done what effect it would have on the economy, and people are starting to see the destruction that could really occur in the economy. So the market slid a lot after this restriction. You can actually see companies like Boeing just completely dropped off after this March 11th restriction. March 14th restrictions were travel from Britain and Ireland. So this just compounded on the travel restrictions imposed from Europe. The problem with travel bans, they destroy production and supply chains. So companies lose their production capabilities. They don't produce as much. They don't make as much money. There's losses of revenue. And then when their earnings reports come out, the stocks drop due to poor performance. And a lot of this was anticipated early on before the companies even started to perform poorly. The stock market started to drop drastically because the investors were anticipating a very large effect and a lot of damage to companies' performance. One of the biggest industries that took a hit was airlines and travel industries. So Boeing produces a lot of the major airliners like commercial airplanes along with Airbus, and Boeing stock completely tanked from a high of $336 a share all the way down to below $100 a share in March. And this was due to them losing sales as companies rescinded orders. There's not really much need for planes anymore as people aren't traveling, and so airlines don't need to order new planes. And Boeing was already struggling with their 737 MAX airplane and the issues with that. And this just compounded to completely destroy the stock and take it down to a third of what it was, less than a third of what it was. And you could also see this across airlines as airlines drop because no one's flying. They're losing a lot of money very quickly, and they still have to pay employees. And then these employees are losing money too. And that all trickles down to the entire economy. The Federal Reserve at this point has to act quickly. There's been a lot of damage to the economy, and you have to act quickly with decisive and massive quick action to save the economy and prevent a complete destruction of the economy. So in 2008, one of the issues was the Federal Reserve responded too slowly to the financial crisis and was too worried about properly allocating their programs so that the right people got the right money, which is important, but it slows down the process. So this time, the Fed would need to act quickly. It would need to act without worry of making mistakes and not worrying about details, but getting massive stimulus programs out to the masses as quickly as possible so that we could keep our economy running, which so far it seems like the economy is losing a lot of money, but is still able to run and function despite stay-at-home orders and things that just completely cripple the economy. And these measures can be done to also help the stock market and keep the stock market from dropping too much as it keeps investors' confidence in the system. It was necessary that the Fed must save the economy at all costs. The Fed started with implementing a 0% interest rate on March 16th. They slashed the rate from its 1 to 1.25% to 0 to 0.25%. They need to act quickly and give people more confidence in securities. The benefits of this are that they're going to promote more loans and investing with lower interest rates. And it's also going to provide comfort and security to the consumers and to the investors and to the people because they see that the system is doing something, that the system's there for them. It develops more trust in the system and hope that they're doing things to keep us safe and keep the economy safe. So stocks initially rose from this. The stock market performed a little better for a short period of time because there's more trust in the system and that the government would do the right thing and be able to stimulate the economy and would be able to help people more and prevent a complete economic downfall. So stocks rose a little bit, but then shortly after that, the reality of the situation and what would still occur and the damage that would still be done caused stocks to then start to go down. The downsides to a 0% interest rate is the idea of it is to have more people invest and spend because they have a 0% interest rate, so that's better. But the issue is in times of uncertainty like this, where people are losing their jobs and aren't sure if they're actually going to be able to pay their bills, they're not really worried about investing. They're not worried about spending. They're worried about buying food, and they're worried about keeping hold of all their money in case there's an emergency, in case they lose their job. So a lot of people are just holding their money for themselves and not spending and not investing, and there's not many loans, and they're just bracing for emergencies. So you lower the interest rate, but it won't necessarily have much of an effect if people can't use that. So the other issue with this is that the Fed left nothing in the chamber. They cut these interest rates to zero, which now can't cut the interest rates anymore because you don't want a negative interest rate. So yeah, it was probably necessary to cut the interest rate to zero, but they did this very quickly, and now they don't have this as a method to ease concerns or to help stimulate the economy or to bring back the economy. Maybe they could have saved some percentage so they could still cut it later on in the process and mitigate effects farther down the road or encourage spending and investing later on when the economy starts to reopen. But no, they cut the interest rate to zero, which means they can no longer cut the interest rate, and they exhausted this method. One of the things this did eventually serve to do was bring light to the severity of the situation, as people saw a zero interest rate as a very bold, decisive move, but also showed that there were extreme concerns about the damage this could have on the economy. So this is why the stock market started to eventually decline after the initial zero interest rate, because people started to realize that there would be massive effects on the economy and that a lot of people lose money and jobs due to this. And so the Fed's massive action may have been good, but also proved that the situation was bad. The next thing the Federal Reserve did was unlimited quantitative easing. This is something that was not done in 2008. This basically means that the Federal Reserve will have unlimited government debt and will buy corporate and municipal bonds. This will help stimulate the economy by allowing the government to not be concerned about how much debt they're incurring, but to just continue pumping money into the economy with different programs, sending people $1,200 checks, giving out business loans and loan forgiveness, helping students, different welfare programs to just help keep the economy running and prop it up as much as they could without worrying about debt, by supporting people that need the support and propping up industries that need help. Like the restaurant industry and small businesses, they were able to benefit a lot from different spending plans and spending bills during this time. One of the issues is that massive debt will be incurred. It's kind of unavoidable, as you have to spend trillions of dollars to keep the economy from falling, and the Fed is just going to keep buying up all that debt. This isn't typically a method we've seen the Fed use before, but it could be a very beneficial method because it will allow the economy to keep running, allow companies to keep producing, and keep paying employees, which all goes back to the stock market, as if companies can't perform well or can't pay employees or lose employees or have to downsize, that's all going to affect the stock market when no one wants to invest in these companies that are performing poorly. But with this quantitative easing and being able to prop up the economy, companies can stay in business longer and there'll be less damage in the stock market due to this. This also helps to keep more confidence in the market as the economy is still running at a higher rate than it should be because we're propping it up and we're spending a lot and the government's spending a lot and implementing different programs. So this will also help to keep a more stable monetary supply and a monetary base, which will help prevent a money divider, which is not a situation we want to be in. And it will also help to promote spending as we keep stimulating the economy with more government spending and hopefully promote spending from others and allow businesses to still spend because they're getting money from these programs. So the more stable money supply and monetary base helps keep confidence in the market and helps keep investing higher, even though it's still drops because of the situation. It may have been mitigated by these methods. And these methods will just provide more safety for people all around, which in a safer economy, you're more likely to invest more in the market and take more risk. So that also helps to preserve the market system. Federal Reserve on this day also announced that they're going to buy treasury bonds and, quote, print money. It's not really printing money anymore. It's more numbers and computers. You don't necessarily have to print paper money. They're going to print money and buy up more treasury bonds. The good parts of this are that it will stimulate the economy because they're just injecting massive amounts of money into the economy to help keep things running and keep a more liquid economy with more moving and not just people holding their money in their houses waiting for the apocalypse. So this will help to keep the money supply and monetary base higher as the money supply is C plus D, the money in circulation plus deposits, and then monetary base is money in circulation plus reserves. So this increases the money in circulation by throwing in a ton of money by buying up bonds. That puts more money into the economy. And then also printing money puts more money into the economy. So at a time when people are spending less, which would normally deflate the economy and result in less money in circulation, there's going to be more money in circulation now, or it's going to even out the effects or mitigate the effects because the Federal Reserve is injecting money into circulation to try to keep things afloat. The downside of this is when you're injecting massive amounts of money and printing money, you can very easily cause high inflation. In a time like this, high inflation would be very painful as people are not getting paid more, they're losing jobs, you're not getting raises, but inflation would cause food prices and cost of living to go up, which could really hurt people. So that's a concern with this. And of course, with all that, you're not going to see much investing. People are going to lose money in the stock market, the retirement funds, they're going to lose money in. So we have to be very careful for the effects of inflation. The Federal Reserve also announced that they're lowering the discount rate. This may not have too much impact on the United States stock market as a whole. What this helps is that it will allow banks to more easily borrow from the government. This will prevent bank runs, which are very dangerous and just built up panic and fear. And then the more bank runs you have, the more panic and hysteria as people are trying to get their money, but they can't get their money. And then spending is affected and people can't support themselves. Then there's chaos ensues and it can get really bad. So this helps prevent bank runs, which is a good thing. And it also prevent bank closures, which is also a good thing. Helps to keep the effect it can have on the stock market is that it will help to mitigate the loss of confidence in the system. People trust that they can still get their money when they need it and that banks are not going under. And therefore, it'll keep confidence in the system, which confidence in the system leads to more confidence in the stock market. as people have confidence to invest and feel they can get their money and access their money when they need it, so they're not concerned about having to hold on to money. And one of the issues we saw in 2008 was that there were bank runs and bank closures, and this led to panic as people feared they wouldn't be able to get their money, so they kept pulling their money out. And that led to a massive decline in the stock market because people couldn't get their money and they're concerned. And then you start pulling money out of the stock market too, because you want to get you want to be able to get all your money, and then the stock market continues to tumble and more people have to pull out money. So hopefully this will mitigate the loss in confidence in the stock market and in the system by preventing bank runs, bank closures, and overall avoiding panic and hysteria. The GDP loss is estimated to be massive for these shutdowns. Just from March 19th to April 15th, it was estimated to be a loss of $1.156 trillion for United States GDP. This was estimated by some associate professors and professors at Virginia Tech in the economic department. And this represents one of the deepest drops in GDP since the index was started in 1944. This is the result of stay-at-home orders and mandatory shutdowns for businesses. People are required to stay at home. A lot of people can't work. They can't produce the same amount. Companies are limited in what they can do, as many businesses and services are closed. And the companies that can stay open can't have their workers producing as much because they're working from home, or maybe they're not working. And so they're struggling with production. So they're producing a lot less, which is dropping the gross domestic product down for the United States. And this represents steep drops in production for companies as a whole. And this is going to lead to declines in the stock market as companies can't produce, they can't perform. So their earnings reports come out and they're not doing so good. They're not making money. They're not making revenue. Investors are going to pull their money out of these companies because these companies are not doing well. And that's for a majority of the market. That's for a majority of companies right now. They're losing money at a very fast rate, and their numbers are bad, and people don't want to invest in them in a climate that's already not encouraging investment. And the GDP can, for this reason, if there's not too many confounding factors, you can correlate the GDP to a stock market's performance. So the United States GDP can be correlated to the market's performance. If the GDP is going down because we can't produce and all, that means our businesses and companies aren't performing well, which means people aren't going to be investing in our businesses and companies. So if there's not too many confounding factors, you can correlate the GDP to the stock market's performance. But you have to remember that correlation does not equal causation. One of the major effects we've seen on the United States stock market due to this coronavirus is extreme volatility. A lot of this is a result of uncertainty and speculation. We don't know what the true impact on the economy is going to be and how deep that impact is going to be or how long it lasts. There's fear about not just the economy and not being able to work or provide food or have a job, but also there's fear of like health and how people are going to survive and different societal and emotional fears. So the volatility in the market is a result of all this speculation, uncertainty, and fear. And we've seen in the past few months days where the Dow Jones Industrial Average goes down maybe 1,000, even 2,000 points in cases, but then it goes up 1,000 points the next day, or even the same day, we'll see a 600-point drop, and then a gain of 700 points on top, like from that. So we see extreme volatility. People are uncertain. They don't know what they should invest in. They're not sure what's going to happen, if they're going to be able to make money. So we can compare the volatility in the market to past events. And so, at least for what we can remember, we remember the financial crisis in 2008, and that led to extreme volatility in the market. But we've actually surpassed that volatility with this pandemic. And part of that might be because we have more technology, we have phones, we have more internet. And so people can act quickly, and they see different news stories, see different reports, and it's a lot easier for them to trade in the market and to buy and sell daily very easily. Like it's nothing, just click buttons on your phone and you can buy and sell stocks. And so along with this news cycle we have, and just massive amounts of information, different reports coming out, speculation about what's happening, people aren't sure what stocks they should hold on to, what's going to perform well, what's going to perform poorly, and they're concerned about losing money because the economy is being crippled. So they're buying stocks for a short period of time, selling them, buying, selling, trying to swing with the market, trying to buy when it drops very low, then sell quickly once it goes up because they don't know how long it's going to be up. So this is all linked to major volatility that has already surpassed the global financial crisis. It has not surpassed Black Monday in 1987, which was kind of short-lived, but was massive volatility on that one day. As you can see in the graph here, the volatility shot up. But what's interesting is we have surpassed the volatility during the Great Depression. You can see around this whole time, there's a lot of volatility for years with the Great Depression, which is something we've already passed in the short period of time. Question is, how long will it last? Could we see something like this with this much volatility for long periods of time? That's all up to speculation. We haven't surpassed the great crash in the stock market of 1929, which is good. We don't want to stocks that are that volatile because a lot of people can lose money, and there's going to be very little confidence in the market, and businesses are going to lose money as they lose market capital, and it's just all around not very good. But this volatility is a result of uncertainty, speculation, and mounting fears and concerns that are rightfully so. We also have to be concerned about revenue losses, as stay-at-home orders are crippling economies and businesses. They can't make much revenue because they can't work, they can't produce, their supply chains are damaged, their labor supply is damaged. As many people have to stay home. We have 30 million people filed for employment so far, and that's massive unemployment. So the labor supply is damaged and the supply chains are damaged. So supply is decreasing, and that means production is going to decrease as businesses can't produce and don't have the means and the resources to produce. Then on top of this, you're also going to have consumer behavior changes. So people aren't buying things that aren't essential. So like you see businesses like Macy's and Kohl's and malls and all, like they're public places that usually attract a lot of people. But one, because of social distancing guidelines, no one's going to these places because of fear for their health. In addition to that, you don't need to go to these places because in a pandemic, you're only buying essential items. You're not buying things you don't need, and many of these stores sell things that aren't essential that you don't need. So these stores are struggling and are losing lots of revenue. You also have the travel industry as being decimated as they're losing revenue. No one's traveling because they're worried about spreading the disease. They're worried about contracting the disease. So no one's flying on planes. No one's using trains. Even cars, not many people are driving, which is why we saw oil go negative, because it costs too much to produce and store and refine this oil that no one's buying anymore. The demand for it's completely shifted because no one's able to travel. And there's also less leisure and less hobbies. Like, people aren't buying for their hobbies or their leisure activities because a lot of those things they can't do with these stay-at-home orders and these shutdowns. And just overall, you see less spending as people are concerned about having to support their families with paying for food and all that. They can't spend as much in the economy. So these companies are just losing tons of revenue due to changes in consumer behavior and not being able to produce. So you can see on the bottom, put less production along with less purchasing leads to revenue losses, which then leads to bad earnings reports, which then the stock for the company declines. So you're seeing damage in the stock market because companies can't produce and can't perform. They can't make money. Why are you going to invest in a company that can't make money? So there's just not as much need as there was to invest in the stock market because we're in uncertain times that aren't safe. So why should you invest in stocks that and companies that aren't producing and aren't making money? You're better off moving your money to um, less like dangerous investments, less risky investments, and just safer things that you can access if you lose your job or if you really need it. So we have stock declines from massive revenue loss. You could see with Tesla alone, they reported their earnings, and the interesting thing about them was that they actually performed better. That could be because their online ordering process, and you also look at companies like Amazon. Amazon's numbers are better as everyone's ordering because they don't want to go out, so they're ordering stuff. Companies like Uber Eats are working more as more people want stuff delivered to their house. They don't want to risk going out. So while you see revenue losses in a majority of the economy and in many businesses like restaurants and everything, you also see revenue increases in certain interesting areas, such as like these food delivery businesses like Uber Eats. They're making more money. Tesla's making more money, possibly because their online ordering process. And you also see different like streaming companies like Netflix is doing really well and making more money because people are staying home and streaming different movies and TV shows and services. So while most are doing worse, there are a few interesting companies that aren't losing revenue and are performing better in the stock market. FedEx is another one. They're delivering many packages and that's helping their revenue. So that's something that's interesting to watch, and we may see a shift in the market. So this is just a map of the stay-at-home orders. You can see in this area, I'm in Maryland right now. You have Maryland, DC, Virginia area, and that's a massive economy that is being crippled by this. As they all have stay-at-home orders. And you have a lot of businesses and tech businesses that produce in this area, and now they're struggling to produce. So that's a massive economy that's being crippled by the stay-at-home orders, along with California and LA area and Washington area. They also have stay-at-home orders and are dealing with the same effects. And along with New York too, those are massive economies for the United States that are all crippled by these stay-at-home orders. because as you can see, most states have at least some form of stay-at-home order. This is just a little graphic that represents the revenue losses projected for the travel industry and tax losses as a result for federal, state, and local governments, which is in the billions. And you can see like air transportation is losing $66.5 billion and over 100,000 jobs, nearly 200,000 jobs, because no one's spending on travel. It's not worth the risk right now. Same goes with other transportation, along with the lodging for travel. Very few people are staying in hotels. It's not the safest thing to do or the best thing to do. So they're losing $76.4 billion in revenue. And that's just projected losses. They could be a little less, but it could be more depending on what happens. We also see recreation and amusement parks, retail, food services, travel planning are all suffering as people are forced to stay home and stay safe. One of the other short-term effects we saw was for a short period of time, the Dow Jones and the S&P 500 both dipped into bear territory. They fell into bear markets, meaning that they were both down 20% from their 52 weeks high, which the 52-week highs actually occurred in mid-February, right before this whole thing happened. We were up almost at 30,000 points for the Dow, which was an all-time high. And then we saw just on March 12th, the Dow plummeted over 2,300 points to put it into a bear market where it was down over 20% from that all-time high. And the S&P additionally fell 9.5% that day, which dropped the S&P into a bear market. The S&P was able to recover from a bear market by the end of the day, but the Dow Jones stayed in a bear market. We're in a bear market for a couple weeks as a result. This initial drop into the bear market occurred because the travel bans. This happened on March 12th, so the travel bans for Europe occurred on March 11th and sent the Dow Jones down as people were concerned about what kind of effect this would have on the economy and how production would be affected in travel and different industries. And so that resulted in a massive drop, historic, comparable to what we saw on Black Monday in 1987, and one of the largest, if not the largest, one-day drop in the Dow Jones Industrial Average in history. Percentage-wise, it was one of the top. And it eventually dropped below 19,000 points at its worst. It has since recovered to closer to 24,000 points, but it was below 19,000 points, which it has not been below since close to when Trump took office in the beginning of 2017. So it was over 10,000 points below its February high, which was over a 30% drop and was deep in bear territory. This isn't good for the market because it leads to loss of trust in the market as people see that the stock market overall is not earning year to year. So that's the danger of bear markets. Luckily, we slipped out of this quickly and recovered for various reasons, and hopefully nothing too bad happens that slips us back in the bear market, because that's not where we want to be. We want to be in the bull market. One of the concerns and topics of speculation for this is what the long-term effects of the lockdowns may be as a result. So we're concerned about like no one really knows what the long-term effects are. So how damaging is this going to be to the economy? How damaging is this going to be to revenue? How many people are going to lose jobs? What's the worst case scenario? What's the best case scenario? So there's a lot of speculation. It's hard to say what the long-term effects would be and whether it's for months or for years that we feel these effects. Some of the game changers are if we have an effective treatment that would reduce deaths and reduce concerns a lot and maybe bring more confidence to people to go out and spend money to go to restaurants, to go to the movies. And we'd see this also for vaccine, because if people are able to get vaccine and have immunity to it, then they're not going to be worried about going out and traveling and going out and going to restaurants and being in large groups and living a normal life. So this would allow for a V-shaped recovery to very quickly go back to normal life with effective treatments, vaccines, so that it's not like we have a slow process where we're slowly getting back to normal life and more confidence, but still taking social distancing measures, still changing consumer behavior and all. And then the effective treatment and the vaccine, if those happen relatively soon, that could allow for a V-shaped recovery, which would be the ideal situation for the economy, the stock market, for health. People would have more confidence and would invest more, and just the whole economy would probably recover very quickly and very effectively. One of the other long-term effects, though, is if we don't get an effective treatment or a vaccine very quickly, we're going to have a shift in mindset and consumer behavior. So even while stay-at-home orders are lifted and businesses are allowed to open up, well, a lot of businesses, bars, restaurants, a lot of people have already said they don't want to go to these places. You can see in this Pew Research Center survey, 77% of US adults were uncomfortable with going to a restaurant right now. This one at the bottom is for restaurants. So 77% of people are uncomfortable with going to restaurants right now. So even if restaurants are only allowed to operate at 25% capacity, a lot of people still aren't even comfortable going to restaurants. So restaurants are going to still be losing money even as the economy opens back up. And same will happen with bars and movie theaters. People aren't going to be doing these things. They're going to be shifting how they spend and allocate their money. Instead of leisure activities that are higher risk, even if they're allowed to do these things, there's going to be fear. And they're not going to want to do these things out of concerns for their health. So you're going to see a change in consumption as consumers are going to shift more to things that are safer, such as maybe Netflix or ordering food, smaller group things, not going to bars, maybe using different methods of leisure and activities that avoid people. So not going to be spending in these industries, but then they're going to be spending in other industries. So what you can see is a change in you can see a change in investor confidence. Then you're also going to see a change in what investors invest in. So if I'm an investor and I'm seeing that nobody's buying, like nobody's going to the movies buying movie tickets, nobody's going to bars, nobody's going to restaurants, I'm going to shift my investment from restaurants. I'm going to start investing in Amazon and FedEx and different companies that are more adapt to deal with this situation. So you could see as the economy comes back and people get more confidence and are more willing to invest, you could see a shift in investing from more traditional things like restaurants and oil and things like that into things that are better built for this, like more investing in electric, more investing in streaming services, social media, graphics chips companies, as more people are using their computers. So it would be interesting to see that in the long term we could have a change in what people invest in. So you might start to get the investors back and the money back in the market, but it's going to be allocated differently. And you can see this top Pew Research Center survey is people who have used um, delivery services for their food, such as Uber Eats and all, in this time, and that's at 21%. So they had done this. Typically, a lot of people don't necessarily use Uber Eats and GoPuff and different services unless they're younger college students. But now you're seeing a lot of people doing this. So that's maybe one of the areas where the allocation shifts. So then here, I just have some stocks I think would be interesting to watch. Boeing's one because they've dropped a lot and they're at a good price, but they're also going to be propped up by the government and kept alive and bailed out by the government because they're too important and employ too many people and provide too many good services. So that's an interesting one to watch. Along with Johnson Johnson and Emergent Biosolutions, as they're teaming up to develop vaccines for this, and they're working hard and having really good progress and headway on vaccines. So that could be interesting to watch. Companies like Lululemon are they've said they've learned from the situation in China and are adapting their methods to perform better here in this current coronavirus climate. So you're going to see companies in like the clothing industry that may, like some may not be able to adapt and they're going to fail. But then others like Lululemon who can adapt, they're going to take over more of that business in this time. And then I put FedEx, UPS, Amazon, they're all delivering and doing great methods like that. And that's all on the rise. NVIDIA and AMD are producing insane graphics chips and graphics cards for computers, and everyone uses their computers more now than ever. So it's also another interesting one to watch. Space industry still isn't necessarily too affected by this. The shutdowns are affecting them a little bit, but a lot of them are still able to do what they work on. So Virgin Galactic, then United Technologies and Raytheon is just a interesting one because they combined and they have a massive company now. So that's just interesting to watch. Thank you and stay safe. Here's some references. That's it.